Hello and welcome back to The Note. The Barbarians are back. Back in the 1980s, private equity investors used to be known as corporate raiders, and they did a number of enormous deals, perhaps most famously RJR Nabisco, which gave us the book Barbarians at the Gate. They've been through some bad times since then, but now private equity is coming to another peak. Is this private equity boom going to end as badly as some others have, or could this be a great opportunity for institutional investors? With me now to discuss this is our private equity correspondent, Anne-Sylvaine Chassany. Anne-Sylvaine, thank you very much for joining me. Let's start with a look at a chart of what's actually flowing in and out of the industry, and it looks as though we're coming to a new peak. Take me through what's happening here.
Well, that's a very interesting chart. You can see here the red chart is the level of cash distributed back to investors from funds, from private equity funds. So they've reached a record last year. It means that private equity groups have been selling assets, listing their companies and refinancing them at a record.
And the bull market has helped them do that, and that's made their investors very happy with them.
Yes, they're very happy.
Okay, now let's take a look at the return they've actually managed to generate. Now, as I understand this is looking at how funds that started in 2007, right on the eve of the crash, would have fared. So
we're talking about the funds that were raised at the peak of the market in 2007. And we're seeing that the half of these are medium average internal rate of return, so net of fees, so the returns annually,
This is what you actually receive as an ultimate investor in the fund.
Exactly. So in 2009, more than half of those funds were posting losses of more than 21% a year.
Right.
And now, look at the recovery. They're now performing about 12.4% a year.
Okay, so they're feeling pleased with themselves.
Yes.
Now, but the big question now, plainly it's easier to do this if you're a private equity investor, if share prices are going up and if debt is cheap.
Exactly.
Let's take a look at the multiples at which they're able to buy companies. This looks rather more concerning to me.
This is concerning because we're entering a new phase of investment. So investors have, gotten all this cash back and they're recycling it into new funds. So this is we're talking about the new investments here. And the multiples, the prices they're doing this new investment at are pretty high. They compare with the 2006, 2007 type of, levels of multiples.
So apart from the very top of what looked in retrospect like a bit of a private equity bubble in 2007, this is beginning to look stretched.
We're not talking about bargains, we're just coming out of a big crisis, and the prices are already very high because of the amount of cash that private equity funds have been raising from investors. They have more than $1 trillion of $1 trillion of cash available for deals, which is unheard of. It's a record. So they need to invest this money, and we're seeing the competitive effect of that.
Okay, and when you've got too much money to spend, the risk that you spend it unwisely tends to increase.
Yeah.
Let's have a quick look at how much of skin in the game the private equity investors themselves have. This also looks a tad concerning to me.
Exactly. So here we have the cash, the proportion of cash coming from the funds, the RBO funds, and the rest is debt. They're using a lot of debt to finance deals. And we can see that the proportion of debt on new deals is now about 2/3, and it compares with levels of 2007, which is slightly worrying, and even David Rubenstein, Carla's co-founder, was worried and expressed some, worries about this. So we're seeing, debt is available, it's cheap, and private equity groups are using it to fund deals. So we're seeing, a lot of leveraged deals.
Now, my final question. Obviously, a lot of institutions are interested in private equity as an asset class, but it looks as though there must be very big deals are out of favour.
Right.
Multiples are very high in the market. Can it really be a good time to be entering if you're an ultimate PE investor?
Even the private equity titans, the founders of private equity, David Rubenstein and even Leon Black at Apollo, they all admit that returns are going to go down. This is a very cyclical industry. Every time there's a big inflow of money, returns are going down. And in a grand scheme of things, this is also a maturing industry, so the returns are going down. Now, in an environment where interest rates are at record lows and investors are starved for yield, this industry is still delivering good returns compared with other securities. So that's how they are, keeping the money coming.
Okay, Anne-Sylvaine, thank you very much indeed. I try to be charitable wrapping up conversations like this. Plainly, private equity has done an extremely good job, judged collectively, at retrieving what at one point looked like a potentially disastrous situation. It still behoves everyone, however, to be very careful about over-allocating to private equity now, because we do know from past experience that mistakes can happen at this point in the cycle.